Why are central banks buying gold? Type in a question mark if you don't know why. Thank you, Jim. To weaken their currencies. So, you have a central bank. You have assets and you have liabilities. Okay? You have gold and you have cash. Okay? Cool. So, the central bank buys 1 billion in gold. Oops, it's supposed to be blue. There we go. 1 billion in gold. What happens to cash? Minus 1 billion. Okay, great. Where did the billion go? Yeah, they had to pay somebody for the gold, right? Yeah, okay. So, great. And usually that's a foreigner. Okay, great. So now we go to the interbanking system. Okay, let's look at this. I'm trying to get this. Okay, this is the quantity of that currency, and this is the price of that currency. Okay, and so we're going to look at the money went into the interbanking system, $1 billion, right? There's 1 billion less gold globally because it's in the vault at the central bank. So in the global supply, there's $1 billion less gold. But in the supply of money, there's now $1 billion more money because it's no longer in the vault. Now remember, the central bank's balance sheet was still balanced. Instead of $1 billion in cash, they had $1 billion in gold. Okay, so nothing's changed. So now we want to look at the demand for money and the supply for money. Okay? And this is what it was. So that's the price of money or the value of money. Price and value is interchangeable. So we'll call that P1 and we'll call this Q1. So what happened? Did the demand go up or did the supply go up? That's right. The supply of money went up by $1 billion. So supply 1 goes to supply 2. You're like, well, what do you mean? Why did you shift it that way? Well, the quantity of money increased by $1 billion from Q1, quantity of the money, to right? You see? Okay. What happened to the value of money? It went from P1 to P2. So the central bank that bought the $1 billion of gold got the gold, maintained their balance sheet, increased the supply of their currency in the interbanking system, and dropped the value, which is probably a good thing for many economies because Japan needs to compete with China for global trades of products and services. And when the currency value is lower, foreigners can buy those products. They become cheaper to the foreigner, like America. So in a way, if China weakens their currency, Japan should weaken their currency. Just to maintain the same purchasing power parity. And one great way to do that is simply by buying gold because you don't have to change interest rates or something like that. You can just increase the supply of money globally, reducing its value and maintaining your exports. Like think about, farmers have to compete. If you sell wheat in America, you have to compete with wheat farmers in Canada, wheat farmers in the Ukraine, wheat farmers in South America, wheat farmers in Australia. Okay, and so foreign exchange can really change the attractiveness of where you want to buy your wheat. Maybe Australia has the better deal this year. Well, maybe Canada has the better deal this year. Okay? And farmers get this. Yeah. So anyways, this is how a central bank does it without changing its interest rate regime and making their economy more competitive globally by buying gold.